Ken, thank you very much for your time to join Top Investors Talk. To some extent, the United States has been decoupling its economy from China. For example, restricting Chinese access to some high-tech products from the United States, like semiconductors. And you said in public that this is a huge mistake. Why?
Overall, for our two countries, the economic integration over the last several decades has been an incredibly powerful force for increasing the welfare of both of our nations. One of the areas in which we've worked together very well over the decades is in the area of technology. The collaboration between our two countries in developing software and solutions, consumer products, has been amazing. It's created an incredible amount of value for consumers in both of our nations. I worry that the decoupling of our software and hardware stacks means less opportunity for consumers to have state-of-the-art solutions, and that having the best and brightest in both of our countries working in different engineering ecosystems will slow the rate of innovation that has so profoundly improved our lives for the better.
China is opening up its financial market. So do you think, what are the most important steps that China has taken to open up its financial market in recent years?
So the Chinese regulators have been incredibly thoughtful about encouraging foreign participation in the Chinese financial markets over the last 15 years. Stability first and foremost as the focus point for the financial policymakers in China. We believe that the foreign capital coming to China will improve the competitiveness of the capital allocation process of the Chinese markets. Western money is often supported by very strong research. This will help all market participants do a better job of allocating their capital. So we're really excited about the impact in China of this opening of the financial markets to foreign firms. And we think it'll help to create an incredible amount of value for Chinese corporates and citizens over the years to come.
Other than the hedge fund business, you also have a market-making business, Citadel Securities, which is a leading market maker in the world. China now is also rolling out market-making business. Would you please tell us a little bit about what role market maker play in the United States?
Citadel Securities, which is managed by my partner, Dr. Peng Chao, is one of the largest market makers in the world in both equities and fixed income securities. Now of note, Peng grew up in mainland China. He went to Peking University, has his PhD in statistics. In fact, we broadcast about 15 billion prices a day to the marketplace, indicating our willingness to purchase or to sell securities. Market makers play a really important role in giving people the peace of mind that the investments they make today, one day they can realize the fruits of those investment decisions down the road in a cost-effective, transparent, and fair way.
Do you think China is right to rolling out the market maker business as part of its process of modernization its market?
As China looks to launch a variety of new financial instruments, the role of market makers will become incredibly obvious. So for example, well-functioning options markets around the world are all driven by market makers. And in the equity markets here in the West, the market makers play a very important role in maximizing liquidity, driving down bid-ask spreads, and increasing market resiliency. These are attributes that we think China will look to embrace over the years to come.
You know, inflation in the United States now is 40 years high. What kind of thing that do you think the Fed should do to control that?
The US Fed has a very, very difficult road ahead of it. Inflation's at a 40-year high. We've never seen this in our adult lifetimes. And what we don't know is the inflation transitory or has it become structural? And the policy response is very different to a transitory period of inflation in contrast to a structural period of inflation. The other challenge the Fed has is we still have about 3 million fewer Americans working than we did just 2.5 years ago. The traditional steps of raising interest rates to fight inflation also slow jobs growth. And we're really trying to, in America, to bring as many people back into the workforce as possible.
Your judgment, transitory or structural?
I'm becoming worried that inflation is more structural. The loss of 3 million contributing members of our workforce means that the labor market is very tight. It means that employees are in a position to demand higher wages. Now that's generally good if that's hand in hand with higher productivity. We don't know the story on productivity yet because of the newly emergent work from home phenomena. What we do know is that much has changed. And on the backdrop of that change, we're in an environment with much higher inflation, millions of people fewer working. We just don't know where this is going to land yet. The Fed's got a tough job ahead of it.
Wars and sanctions mean inflation. What is going on in Ukraine means to the inflation and the Fed now?
Obviously, the war in the Ukraine is creating yet additional supply shocks, whether it's reduced harvesting of wheat, whether it is sanctions related to energy, which is impacting energy prices around the world. The events in the Ukraine are yet another pro-inflationary shock. We both hope that this is a transitory phenomena. We hope that peace breaks out in the Ukraine and that this shock is put behind us quickly.
Ken, do you think the central banks in the Western world should slow or maybe stop the tightening process due to what's happening in Ukraine now?
I believe that that is an incredibly insightful question because we have both, again, another inflationary shock, but we also have the prospects of a recession in Europe. The increase in energy prices in Europe is so stunning that unless we see a rapid resolution to this conflict, in this case, the risk of a recession in Europe, that makes the path for central bankers far more difficult to walk. Having said that, if I were the Federal Reserve of the United States, I would do the next interest rate hike as expected. The market's anticipating it. It'll help to cool inflationary expectations. I think that's the right next move. But if we see continued negative economic impacts from this war around the world, we will be left in a very difficult situation where perhaps stagflation, the absolute worst nightmare for any central bank to deal with, we may see that emerge.
You know, Citadel had 2 very strong years during the pandemic, outperforming its peers. As far as I know, Citadel is a multi-strategy fund. Would you please explain to us what does that mean?
The last 2 years, every nation in the world has grappled with the impact of the pandemic. We have found that that has created an incredible number of challenges for everybody who invests capital around the world. We deploy our capital across a variety of different strategies, which is why we're referred to as a multi-strategy fund. Whether it's the trading of commodities, fixed income securities, equities, weather derivatives, we invest in a very broad array of financial instruments and assets. As such, we're well positioned to benefit from both the power of diversification and the ability to move our capital to where the best and highest opportunities exist. And that has driven for us a very successful 2 years.
Citadel runs both fundamental research and quantitative strategies. So do you expect quantitative investing to overtake fundamental investing in the future?
This firm has a very, very deep and rich heritage in the use of software, of predictive analytics, of quantitative investment techniques that date back to the very origin stories of Citadel. They play an incredibly important role in how we allocate capital. But in my opinion, nothing trumps the judgment of my colleagues as people in making their investment decisions. Our quantitative strategies are very important to us, but capital globally will be managed over the course of my lifetime by very thoughtful, careful, and considerate individuals who are really thinking about what is new, what is emerging, and what is going to change the world.
Do you think one day computer will be better at investing than humans, similar to how computers are better at chess?
Computerized trading or quantitative investing does extremely well in both the trading of short-term portfolios and in the use of information that arrives at a very high rate of speed, at a higher rate of speed than humans can generally assimilate or understand. But that's more about trading and less about investing. Investing, thinking about the next Alibaba, the next Tencent, the next Apple, the next Nvidia, this requires a level of understanding of businesses, business models, competitive advantages that computers just are not going to have over the course of the decades ahead. That's why people play such an important role in our financial markets, is they have the judgment and the wisdom to recognize what's new, what's going to change the world, what's going to create value. That's outside the realm of quantitative investing.
How much importance would you give to the people's involvement in quant investing? Like 30%, 40%, or 50%?
It depends on the strategy, the horizon, how long you're going to own an asset for, and what types of assets that you're trading. So for example, there was an equity in the United States where most of the workforce was employed in the Ukraine. Your computer-oriented trading systems today just don't understand the risk that that had for the company at play. Because of course their workers couldn't go to work anymore. And we're just nowhere near that day and age when computers will understand those types of risk factors and make the right decisions in moments of time like this.
Chinese regulators now are issuing more and more regulations on quant investing. So how do you see that trend from the global perspective? Where is the balance?
Regulators around the world are very focused on market access controls. Now in China, there's been a rapid increase in assets under management in the quantitative investing space. We've also seen some of those firms have some recent difficulties in their performance. And I think regulators are always very concerned in selling products to retail investors. Does the retail investor understand the risks and the rewards of what they're investing in? And to the extent that quantitative funds are harder to understand, around the world, regulators think about, are the appropriate disclosures being made? Are investors in a position to make a really wise decision about their allocation of capital to those funds? So in any rapidly changing investment space, it's really important to see regulators play an active role in making sure that the interests of investors are represented and protected. And I applaud the Chinese regulators for having the focus in this area of very, very fast growth.